Hello, and welcome to the February edition of the Corporate ESG 5 and 5 podcast, the podcast in which we spend 5 minutes exploring the key ESG trends set to shape the market this month. I'm Roze Warren from Debt and Financing Solutions, and I'll be taking you through this month's key focus, the future development of ESG data. Corporates are under increasing pressure to assess sustainability across their value chain, from suppliers to customers, and to take action against sustainability issues. Investors are focused on the integration of ESG into their investment decision-making, and banks are integrating ESG factors into their capital and risk management. But the quality and coverage of ESG data are frequently cited as two key challenges limiting corporates, investors, and banks alike in their ability to address ESG issues. Two recent announcements in our February corporate ESG briefing highlight a select few of the many work streams underway globally to improve the quality and quantity of ESG data available. For example, in the US, the Biden-Harris administration launched a new national strategy to include nature-related data within US national economic statistics. Examples include the value of natural assets like land and water, and this project aims to reduce the knowledge gap between nature and the economy. The European Central Bank has published a series of climate-related statistical indicators. These are intended to narrow the climate data gap and help improve understanding of how climate change will affect the financial sector. These indicators are a work in progress and intended to engage researchers and data providers on how to capture better data on climate-related risks and the green transition. So the importance of ESG data is clear, but how do we expect ESG data to develop as we look forward? Well, a good starting point is to look at the current picture of sustainability data. The rapid development of the ESG reporting landscape has resulted in a plethora of reporting frameworks, principles, and standards, and there are more in the pipeline. This rising tide of regulation has driven an increase in corporate ESG disclosures and therefore increased the quantity of sustainability data available. And although the reporting landscape continues to develop, there is a lack of standardization, resulting in inconsistent ESG data. Each reporting framework has a slightly different purpose, requiring different disclosures with different metrics, resulting in different outputs. So one of the first trends expected is the consolidation and standardization of disclosure requirements. Several consolidation initiatives are already underway, including recommendations for a set of universal ESG metrics to be included in company annual reports. Likewise, the Global Reporting Initiative and the Sustainability Accounting Standards Board are both working to harmonise their disclosure frameworks. Another development is that ESG rating providers are facing increased scrutiny from both investors and regulators. At the moment, the underlying data used within ESG ratings is not quality assured, which limits their reliability. Regulation of ESG rating providers will enhance data quality and improve data accuracy. Regulatory bodies in Europe and the UK, including the European Securities and Market Authority, or ESMA, and the UK Financial Conduct Authority, have indicated plans to regulate ESG rating providers in the future. The third development is that more timely and insightful ESG datasets are becoming available that use technologies such as satellite data, artificial intelligence, or sensor data to offer a different perspective on a company's ESG performance. For example, FactSet's dataset uses natural language processing, machine learning algorithms, and sentiment analysis to review news articles and documents daily. This gives investors a real-time view of how companies are handling ESG issues. Finally, the demand for quality nature-related data is rapidly increasing, driven by the landmark Kunming-Montreal Agreement at COP15 in December last year, alongside the publishing of the draft disclosure framework from the Task Force on Nature-Related Financial Disclosures, or TNFD. To improve their disclosure framework, the TNFD launched a series of workshops with existing biodiversity data providers to identify shortcomings in data analytics and tools. We are also seeing more companies start to develop nature and biodiversity data analytical tools, including companies such as Nature Alpha and Iceberg Data Lab. Biodiversity data will be a key area of focus for 2023. Thanks for listening to this month's Corporate ESG 5 and 5. I hope you found it useful. And as always, please be sure to check out our monthly newsletter, linked in the description, for more on the key ESG trends shaping the market this month. And If you like this episode, please follow the channel and click the notification bell so you can get future episodes as soon as they are released. Thank you again, and see you next time.